You are listening to ESG News and Views from the Conference Board.
Hello, this is Paul Washington, Executive Director of the ESG Center here at the Conference Board. The ESG Center focuses on corporate citizenship, sustainability, and governance. Today we're going to talk about climate change and how two very powerful but different constituencies, investors and philanthropists, are addressing this issue and how they can actually work together. Earlier this year, Larry Fink, the chairman and CEO of BlackRock, the world's largest asset manager with $7 trillion under management, wrote to CEOs saying that we are on the brink of a fundamental reallocation of capital based on climate change, which will favor those industries and those specific companies that are more energy sustainable, and importantly, that climate change is an issue that every company needs to address. About a month later, Bill and Melinda Gates issued their 20th annual letter, noting that the Gates Foundation is now adding climate change to an even higher priority on the list of issues that they're addressing. So you have the leaders from the investment and philanthropic worlds making very public statements about climate change. Today, to discuss the gauntlets thrown down by Fink and Gates, I'm delighted to be joined by two guests, Carl Pope, former executive director and chairman of the Sierra Club, who currently serves as principal advisor at Inside Straight Strategies, a consultancy focused on the intersection of sustainability and economic development, and Satyajit Bose, a professor at Columbia University in New York, where his scholarship focuses on, among other things, sustainable investing. Carl and Satyajit, welcome. Thank you very much for being here.
Delighted to join you.
Thank you, Paul.
So let's just start with the basics about these letters. Carl, what did you make of the Gates letter?
Well, I think what the Gates letter underscored was that historically climate change was an issue that foundations and philanthropists undertook under their environmental umbrella, and if they didn't have an environmental umbrella, they were unlikely to get deeply involved in climate. Climate is broken out of that, unfortunately, because the reason it's broken out is because the threat it poses is so broad and so sweeping and so deep. And I think what the Gates letter signals is that serious philanthropy that wants to tackle the world's biggest problems now has to take into account the reality that almost all of the world's biggest problems will be greatly multiplied and exacerbated if we don't cope with climate change.
That's really interesting. And Satyajit, do you have a similar take on the Larry Fink letter?
Yeah, I mean, the investors and asset owners in particular command very large amounts of capital. So even if they change their attitude towards capital allocation just a little bit, that has a huge impact, for good or ill. I would say that BlackRock has historically just been much more of a passive investor. And there are other active investors that have been looking at this for some time. And in fact, about 30% of all professionally managed assets are focused on various flavors of sustainable investing. So the BlackRock letter is sort of a sign, a tipping point of a greater movement that has started some time ago.
Thanks. And let me pick up on that idea of the potential impact that these folks can have. Because if you think about the various players who are trying to address climate change, you obviously have governments, you have consumers, you have corporations, you have investors, and you have philanthropists and NGOs, among others, right? So I'm just wondering about the potential impact that either the investment community or that philanthropists can have, given the trillions under management by investors and the hundreds of billions, at least, under management by philanthropists. So, Satyajit, do you want to talk about the relative impact that investors can have, maybe even as compared to government?
Yeah, well, investors, they're mostly investing in large corporations. And corporations are much bigger than governments today. The old picture that we learned in economics 40 years ago was you had the government that was there to correct the failures of the market, that businesses were out there trying to make profits, and in so doing, they would destroy the world unless they were regulated, and the government would regulate them. But the reality is that most corporations are much larger and more powerful and geospatially dispersed and spread out than most governments. And they also have much better information. So it's really important to impact those corporations' behavior in order to save the world, so to speak.
It's really interesting. And in some ways, corporations they can also have maybe better information because they're closer to consumers sometimes than governments are to their constituents. And Carl, what's your take on the potential impact that either philanthropists or investors can have here compared to the other players in the field?
Well, I think it's interesting that we've been talking about information because, in fact, information asymmetry is one of the fundamental causes of the failure of our economic system to respond properly and rationally to the threat of climate. And one of the things that philanthropy can do, because it's a very high leverage activity, but it's not necessarily requiring trillions of dollars. It probably does require billions of dollars, but that's what foundations have, is to make sure that all of the players in the game actually have access to the same information, to correct information, and to information which is both adequately inclusive, so it tells us what are we doing, yes, to the climate, but also what are we doing to air quality and water quality and justice, but also tells us far enough out into the future so that both investors and governments, in making their business decisions and in regulating those business decisions, can keep their eye on the important balls.
That's great. So let me continue on with that. So information gathering, sharing, verification, and all that is something that philanthropists can bring. Could you talk a little bit more about the particular strengths and even maybe some of the weaknesses that philanthropists bring to addressing an issue like climate change, especially, I suppose, if you're talking about some of the ones you're mentioning before, who may not actually have environmental issues as part of their core competency. So, curious about your thoughts on the strengths and weaknesses that the philanthropy community brings to this challenge.
Well, I think philanthropy's great strength is its business model doesn't determine its bottom line. If you're an automobile company, it is actually quite difficult if you decide that actually cars are maybe a somewhat dubious idea. It's hard to figure out what to do about that. If you're a foundation that has been giving money preserving...
What you do about that, by the way, is you redefine yourself as a mobility company, I think is what happens usually. So when magazines were in trouble, they redefined themselves as publishing companies. But anyway,
and
sorry.
They don't always make that transition gracefully or effectively. But on the other hand, if you're a foundation and you've been giving to preserve wild land for habitat, and you decide, oh my God, that land is going to be underwater if we don't do something about climate, it's actually not as big a deal to change your giving focus. I mean, it will take you some time, some planning, some learning, some expertise gathering, but you can do it. The big disadvantage of philanthropy is that the fact there's no clear bottom line means they don't have a disciplinary factor that governs business and makes business often more effective than philanthropy, because philanthropy can wander off and spend an awful lot of time debating theories of change rather than adding to its intended bottom line. So philanthropy hasn't mostly been that effective in the climate arena because it's operated on the premise that the information the world needed was about the climate problem, And philanthropy has had a hard time grasping the new reality, which is what the world needs is information about climate solutions.
Got it. And Satyajit, thinking about the asset manager side, clearly they've got a bottom line that they've got to address, and I don't know if that's a strength or a weakness for them. So what do you think about
Yeah.
the strengths and weaknesses that they bring to this
Yeah, let
endeavor?
me tie it into something that Carl and you just mentioned, about the car company becoming a mobility company. Um, Luckily, it's not the corporation that has to make that systemic decision. So this might be seem like a plug, but we have a book out called The Financial Ecosystem: The Role of Finance in Achieving Sustainability, which really talks about what are the different levers um, of different players within that financial ecosystem. So investors are a key player because most investors are not. Most investors are what we call the citizen investor. That is, the largest stakes in largest corporations are owned by pension funds, mutual funds, sovereign wealth funds. They're not owned by the plutocratic billionaires. And so the investors actually have a very strong interest in the preservation of the overall ecosystem. It's that we have this principal agent problem, the information asymmetry that Carl talks about. Not only is it the difficulty of getting the right information out to all the stakeholders, but it's also one of gathering that information. Investors in general are incented to gather information to, for example, look for new trends, new sources of risk, new sources of opportunity. They're very good at pricing risk, at building efficiency, partly because of the bottom line, but it's not as simple as reducing costs. It's thinking about what the future would look like. And typically they're not looking 50 years out, but they have the discipline of looking 5 years out and thinking, what's the product and service that's going to do well? What's not? And then building for scale. And so that's the real strength that investors can bring. They have weaknesses, though. Investors are focused on money and they're focused on too short a horizon, unlike the philanthropists. You see, so they basically also cannot think about the bottom of the pyramid in quite the same way, because to them making money 3 years out inevitably means making money from those who have disposable income, and that will include large proportions of the world's population, those who really need the help. So that's where they need to really work with the philanthropists on the forward thinking ideas, and then understand how to disrupt the industries, whether it's going from cars to mobility, um, to staying at home, and then scaling up those solutions.
Okay, so that's a perfect segue to the next topic I wanted to delve into, which you've already started on, which is, how do these two communities work together? I mean, uh, you often just read about their endeavors that are quite separately, and the only time that sort of the investment side seems to be talked about with regard to philanthropies is whether a particular foundation is investing in, fossil fuels and so forth. But I think you're all touching on something that's at least one area of deeper collaboration, which is on foundations and philanthropists focusing on gathering information, generating a long term perspective that can then be used by asset managers in terms of the allocation of capital, including to specific initiatives that could result in innovation and so forth. So I think that's a really interesting potential marriage there. I'm wondering if there are other areas of collaboration that you can think of, and whether there are any specific examples you might be able to point to thus far.
Sure. Actually, Carl is an expert on this area known as blended finance, but I'm also happy to jump in. In general, blended finance, or some people call it catalytic finance, is an effort to take into account that all activity, not just economic, but activity that encompasses financial capital, natural capital, and human capital, requires multiple sources of capital and requires them to be invested in different ways. So normally we think of capital structure in the finance world as equity and debt and mezzanine and everything in between. Um, but you can also imagine it as there is social capital, there is different stakeholders that need to put in some form of contribution. If you look at a company like Uber or Facebook, there's a company that is providing a software service, but then there are a whole set of stakeholders. The consumers, the users of Facebook are giving up their whole emotional lives, their photos, things that are really important to them. And that's a contribution to that system. Facebook wouldn't be what it is if it didn't have the trust of its users. So thinking, we have examples. Typically, what we've seen is what we call policy entrepreneurs who try to work out ways in which you can bring together the value from different stakeholders. So that could be an example where you've got a Caribbean country that needs to get access to cheap energy. Right now, they're heavily dependent on diesel fuel for electricity. And so the Inter-American Development Bank works with philanthropists, small governments, as well as investors in public listed securities, to take out some of the risks of, for example, investing in geothermal or other forms of renewable, and finding philanthropic capital for that. And then once that risk is taken out, using listed regular market-based return capital to scale it up. So you basically have philanthropists investing in risk mitigation or taking the first loss, and then you have in broader investor sets scaling it up. That was a long response.
Let me give a concrete example that I think is interesting. In India, South Asia, Africa, you face the dilemma that there are billions of people who don't have electricity and who light with candles or kerosene. It turns out lighting with candles or kerosene is actually more expensive than lighting with electricity, particularly if the electricity comes even from a solar panel on your roof. A solar panel on your roof is much cheaper over the long haul than using kerosene, but if you're a poor person, you don't pay in the long haul. You buy kerosene by the day, you buy solar power by the year or the decade, and so if you're poor, you can't afford to do it. You need a financer, but there are no banks in the village. There might be a rural bank in the nearest district town, but somebody needs to train people to be sales agents and loan agents to make all that happen. And when both Africa and India have confronted that problem, they've had to fall back on blended finance solutions in which philanthropy, or in the case of one African project, it was AID, pay to get the project planned and ready. OPIC, which is a U.S. government agency which guarantees foreign investments by American investors, then put up the first loss risk, and then U.S. private investors were able to come in and loan the money to Indian or African entrepreneurs to build the local companies. And this has been extraordinarily successful, but you couldn't have done it without each layer of that risk stack.
Okay, those are both really helpful answers. And I think that underscores that there's actually a fair amount of complementary advantages that philanthropy and the investment side of the house bring to this. They bring complementary perspectives, complementary skill sets, complementary capacities when it comes to information gathering and deployment, and then, frankly, capital. The money that they bring can really work together to make a concrete difference. So I think that's really helpful to illuminate. Thank you, and that's a great example of it. So let me turn from that subject to a slightly different one, and which is, how you measure progress. How you become more efficient at this. So let me ask: are there strategies that either philanthropists or asset managers or both should be deploying right now to increase their impact? In particular, strategies that you think would actually have them be more effective at what they're doing than what they're doing now. Carl, I don't know if you want to start with that.
Well, I think on the investor side, you really fundamentally have to say if climate change is as big as all the science, without exception, says it is, the future will not be like the present. And if you look at every investment decision, knowing that you don't know exactly what the future is going to be like, but you should assume major phase changes, not just smooth incremental changes. You should expect disruptive change, both positive and negative. And if you start saying, I'm not just going to invest based on today, I'm going to, for example, it turns out, for example, that if you had a passive index fund, for the past 15 years, that fund performed better if you had simply left the fossil fuel sector out of it. Now, that's contrary to the conventional wisdom, and it's contrary to the way in which passive index funds are constructed. They're constructed to reflect today's market, not tomorrow's market. So one of the things investors should be doing is looking for ways to build more of tomorrow into the decisions they make. They're never going to get it totally right. Nobody knows what tomorrow's going to look right, as this current virus has reminded all of us, I hope. Mm-hmm. On the philanthropy side, philanthropy's problem is that it worries about it plays defense. If we're talking about baseball, it's on the defense, and they're looking for fielding averages. They want high fielding averages. They want 95% performance. They ought to be thinking of themselves as batters, as being on the offense, and they ought to accept the fact that most grants they make will not work. If all your grants work, your grants are not bold enough. They need to be making more effort at taking risks, because that's what they can do uniquely. They can take a risk, and they're doing it with relatively modest sums of money, and the 5 things that don't work don't matter that much in terms of waste of social resources. But the 3 things they show will work enable everybody else to crowd in with the big money.
That's really interesting. So investors should be taking more of a long-term perspective and really a forward-looking perspective. And philanthropists should be doing, it's Warren Buffett's phrase that shows up in the Gates letter, swinging for the fences. You may strike out more often, but when you actually connect, you're going to have, a much bigger impact.
And the dominant paradigm in both sectors right now is the opposite. Philanthropists spend an enormous amount of time making sure they don't make mistakes, and investors are very deeply rooted in tracking the present.
Right. There's a lot of bunting going on, basically. That's it for me for baseball analogies. So Satyajit, what are your thoughts on what investors or philanthropists should be doing differently, if at all, to have more impact?
Yeah, well, I mean, look, I'm not good with the baseball analogies.
So give us cricket. Give us cricket.
I know. Yeah, whatever.
Yeah, well, I mean, you'd hit for the sixes, I guess, the 4s and the 6s. But I couldn't agree with you more. There's not enough risk being taken, and I would say that it's not just investors and philanthropists. The measurement system is too grounded in the short term, right? We all know that for investors, the measurement system has been about quarterly earnings, and that's a significant problem. I mean, the one good thing that is sure to come out of this COVID-19 situation that is so unfortunate and traumatizing for so many people. The one good thing is seeing this kind of phase shift, as Carl calls it, come out of nowhere and understanding why it's so important for anybody who's leading an organization, running a corporation, allocating capital at the investor level, or academics, for our part, thinking about what the future might look like. It becomes so important to think about scenarios, and this is what, of course, the TCFD is all about. Maybe I should explain what that is.
Sure.
But understanding what future possibilities are and incorporating that into your decision process and building little hedges for the future. What it's a kind of investing that is known as investing by making small bets that take into account a range of possibilities, not being super evolved for the current situation that you're in.
Hmm. Interesting. So, right, again, and that picks up on Carl's point about really investing and acting with a future perspective and not just being super tuned to managing the what might happen in the current quarter, which is itself probably a challenge these days. So let me ask you, are there better ways of, you've touched on it a little bit, better ways of measuring the impact that philanthropists and asset managers are having on climate change? I mean, how do you really sort of assess the bottom line? And maybe that's not even the right question. Maybe we shouldn't be focused on that, and maybe it's just more about the process and the effort than it is having some sort of wonderful quantification of impact. But assuming that people are looking for measuring the impact that they're actually having, are there better ways of measuring the impact that these constituencies are having?
Well, I'm going to be disruptive and suggest that one of the basic things we have to assume is the reason we don't have the right information is not because it doesn't exist, but because it's being hidden. And that's the agent principle problem. And I think the most important thing for either foundations or investors to do is to try to figure out what's the information that enterprise managers don't want you to have, because that's the information you need. For example, in the oil industry, the information oil companies don't want either investors or regulators or foundations to know is what they're assuming the future price of oil is in making their exploration and development decisions. They're very, very reluctant to tell you what their hurdle rate is. And that's the most important fact for everybody to know, because it tells us whether Exxon is, for example, betting on a world of $100 oil, which makes oil look a lot less attractive economically than if you're betting on a world of $30 oil. If you're a consumer, which most of us are.
Yeah, Satyajit?
Yeah, so I totally agree with Carl on, the data gets produced if people want you to see it. So if you really want to measure a system, you got to look harder for data that's not at the surface. And that can be very difficult to do. So, we have a whole approach to impact measurement. And basically, my conclusion over years of studying this is you simply have to add many, many metrics. And you should never measure based on single or a few metrics. So that means if you're evaluating your portfolio, you shouldn't be looking just at growth in quarterly earnings per share, but you should be looking at, of course, all other financial metrics. But guess what? Financial metrics are the ones that are most gamed. And those are the ones that'll tell you the least. Those are the ones that have already been incorporated into the market understanding. If you want to discover new things, whether this company is managing and cooking its books, whether this company is least likely to survive a disruptive episode, you will have to look at other metrics that are not financial. That's why we pay so much attention to ESG. If you were evaluating students, if we're trying to decide which students should get into our college, well, if we just relied on a single metric like their SAT score, then the chances are people would invest heavily in trying to get the highest SAT scores. They'd spend all their time trying to prep for it. And then we'd get a certain kind of student who wasn't good at much else. And it wouldn't be a good indicator of future success. So whenever you evaluate people, any important decision that we ever make in life, it's never made on single metrics. And we always have a whole portfolio of metrics. So that's what we do. We work very hard on building indexes that have underlying diversity of metrics.
Okay, great. And look, that's probably a subject for a whole separate podcast, because the challenge of, figuring out what it is that companies should be measuring and reporting on is a particularly challenging one, given that there are multiple reporting frameworks. There are about 200 different ESG rating agencies out there. There's a little bit of maybe a disclosure overload, but part of the challenge may be it may not be the information that really matters, which you're touching on here too. So maybe it's coming up with multiple metrics, but the right ones, but then you actually have to tailor them somewhat for each industry and each company. So it's that probably is a subject maybe for a couple podcasts. So let me conclude this one with just a general question. I think a number of us believe that the current COVID-19 pandemic is going to increase the emphasis on climate issues, although even in the short term, it's diverting some resources and attention, obviously, as companies are focusing on survivability and liquidity and so forth. But that over time, this will actually increase the focus on climate. Do you agree with that, or do you disagree? And what's your take on that?
Yes, absolutely. So, here's the thing. After the 2008 financial crisis, people said, hey, no one's going to pay attention to ESG now because we've just had a 40% drop in valuations and everyone's focused on maintaining earnings, recovery, and so on. But actually, what we saw was sustainable finance got a boost. The percentage of assets under management that gravitated towards ESG integration, towards positive, best-in-class, various sustainable investing strategies, actually increased. And the crisis, whether it was the 2008 financial crisis, this current crisis, what it does is it makes asset owners look for repeatable sources of return. And what they're doing is naturally gravitating towards natural and human capital. The financial capital is actually far more abundant today than natural and human capital. We've got interest rates at zero. We've got tons and tons of money being made available. So money is actually not the problem. The scarce resource is human capital, knowledge, and nature. And I see people focusing on public health. It's very clear that well-being trumps money. We have recognition in the value of our interconnectivity. We have growth in local resilience, local manufacturing, distributed energy, local food systems, farmers markets. Everybody focused on that at the expense of money. So I think this is actually going to be a great thing long term.
All right. Well, we'll let that be the final word. And we all hope something good comes out of this. So, look, thank you very much, Carl and Satyajit, for what has been a really terrific conversation. And thank you all for listening to this episode of ESG News and Views. If you enjoyed this conversation, I encourage you to visit conference-board.org for the latest insights and resources on ESG matters and a whole panoply of information relating to the COVID-19 pandemic. Once again, thanks for joining us today.
This has been ESG News and Views from the Conference Board.